Right now, India's economy is probably the biggest story on the global stage. But what's really going on behind the headlines? In this explainer, we're going to unpack the core thesis, the big idea that has investors all over the world sitting up and paying very close attention.
Okay, let's start with a number. This one, right here, 6.5%. This is the figure that's at the heart of this entire story. It's Moody's forecast for India's economic growth, and not just for 1 year, but steadily right through 2027. Now that is a remarkable pace, especially when you look around and see so many other major economies kind of hitting the brakes. So what does that 6.5% actually mean in the grand scheme of things? Well, it puts India at the very top of the list. We're talking about the fastest growing economy in the entire G20. And look, this isn't just some number on a spreadsheet. This is real, tangible momentum that's pushing India right to the front of the global pack.
Now, what's really getting analysts excited is that this doesn't feel like some temporary rebound. They keep using this phrase, a structural bull cycle. Sounds complicated, right? But all it really means is that they believe this strong growth is now baked into the system for the long haul. We're talking years to come, all thanks to some major policy changes and a really solid domestic foundation.
All right, so let's get into the nitty-gritty. What's actually powering this whole transformation? Well, the entire thesis, the whole story, really boils down to 3 main growth engines. Think of them as these huge, powerful clusters that are all firing at the same time.
Okay, so what are they? First up, you've got this massive wave of government spending on big projects, the CapEx megacycle. Second, a huge push in manufacturing, helped along by something called PLI schemes. And third, the engine that powers it all, the domestic consumer. Let's dig into each of these. So, let's start with the first one, the foundation of it all. We're talking about a truly historic push in capital expenditure. Basically, the government is investing on a scale we've just never seen before to build, well, everything. Think highways, airports, ports, and even the digital networks that connect us all.
And when I say the scale is big, I mean it's absolutely staggering. Just look at that number, over 11 lakh crore rupees. That's what the government is pouring into infrastructure just in its latest budget. It's a massive statement, a clear sign that they're committed to building a modern, super efficient economy right from the ground up.
And here's the thing, this isn't just a one-time splash of cash. Nope. If you look at projections from folks like Morgan Stanley, they see this investment steadily climbing as a piece of the total economic pie, from 5.3% of GDP today to a projected 6.5% by 2029. That tells you this is a long-term, multi-year plan. They're not just patching things up, they're building for the future.
Okay, on to our second engine, manufacturing. And there's a really interesting story shift happening here. For years, the slogan was "Make in India," right? An invitation for foreign companies to come and build here. But now, it's evolving into something much more powerful, a reality where products are being designed, developed, and truly made by India for the rest of the world.
And you can literally see this change happening on the ground. I mean, look at the physical landscape. By 2027, manufacturing is projected to take up almost half, a massive 46% of all new industrial real estate. This isn't just a policy, it's a construction boom. New factories, new facilities popping up all across the country.
And the results? They're already rolling in, and they are impressive. Electronics exports? They surged over $29 billion last year. Pharma is right behind, closing in on $30 billion. And it's industries like auto and engineering that are really driving the demand for all that new industrial space we just talked about. Okay, but underneath this massive manufacturing boom, you'll find the real engine room of the Indian economy. I'm talking about the micro, small, and medium enterprises, or MSMEs. Now, these guys are absolutely critical to this entire story. But here's the twist. They also represent one of its single biggest challenges. I mean, just get your head around the sheer scale of these businesses. They contribute almost a third of India's entire GDP, they're responsible for a staggering 45% of the country's exports, and they provide jobs for over 240 million people. Let that sink in. They are, without any doubt, the absolute backbone of the economy. So that leads us to the million-dollar question, right? We know they're vital. But how do they actually stack up against their counterparts around the world? You know, when it comes to pure efficiency and competitiveness? And this is where we find the big challenge. The average MSME in India is only about 18% as productive as a large Indian company. Now compare that to developed countries in the OECD, where that number is way up, between 45 and 70%. That huge gap in productivity,
It's like having a handbrake pulled on a supercar. The engine is roaring, but something is holding it back from hitting its true top speed. So why the gap? Well, it's driven by some really deep, structural problems. For starters, there's a massive credit gap. We're talking an estimated 30 lakh crore rupees they can't access. Add to that intense competition, technology that's not being adopted evenly, and just the sheer difficulty of plugging into those big global supply chains. Tackling these issues head-on, that is the mission-critical task for policymakers right now.
Okay, so we've got this really interesting picture, right? Incredible growth on one side, but some pretty significant challenges on the other. So what's the verdict from the people who bet big money on these things, the global financial markets? How are they pricing this whole story?
Well, let's start with Goldman Sachs. They've turned bullish, which is Wall Street speak for very optimistic. They've upgraded Indian stocks because they think a rough patch, a period they call an earnings downgrade cycle where profit forecasts were falling, is finally over. They see momentum coming back in a big way and are calling for the Nifty index to hit 29,000 by the end of 2026.
And they're not alone. Morgan Stanley is seeing the same thing, a broad market revival just over the horizon. What's interesting is they think the market is shifting. It's not just about picking individual stocks anymore. It's going to be driven by the big picture economic story, those macro trends that we've been talking about this whole time. Their target for the Sensex? A cool $95,000. HSBC is right there with them, echoing that same feeling. They're pointing out that stock prices or valuations look a lot more reasonable now after a bit of a quiet period, and that all-important earnings momentum is really starting to pick up steam again. Their target? 94,000 for the Sensex by the end of 2026.
So you see the pattern here, right? Here's the key takeaway. Despite all those internal challenges we talked about, a really powerful consensus is building among these global heavyweights. They're looking at the big picture, the major tailwinds, and they're seeing company profits starting to revive. And for them, that combination is just too strong to ignore. It's building a really compelling investment case for India. And that brings us right back to our final thought. The big growth engines, they're firing on all cylinders. The global markets, they're clearly bullish. But where India's economy goes from here, its ultimate trajectory, really hinges on one single thing: releasing that handbrake. Solving that MSME productivity puzzle isn't just a side quest, it is the key to finally unlocking the full, truly staggering potential of this economic supercar.